So, Stav, I know we're back in the buyback window now. I think it started a
Yep.
few days ago, and you've got record amounts of buybacks, so that could certainly be a positive impetus for the market. No.
Yeah, I mean, I'd rather talk about Greece. It's a lot easier.
No, that was that.
That was that was
We'll do Greece. We'll do Greece another time, not now.
yeah. No, it's I tell you, the markets are tough. These are the type of markets that my one of my mentors used to say. You kind of want to do the opposite of what you feel. It's a trading range, and basically, when you think you got it and you're shorting and you're making money, it's probably time to do the opposite. And for the bulls to start getting comfortable, it's probably the wrong time. So you have to stand guard. The problem, George, and you know this, is that we look for drivers of the market. So what's driving the market? And I hear a lot about '08. This is a completely different market because the leverage and the positioning is not in the private sector. Corporations don't have a lot of debt. Individuals don't have. I mean, they are borrowing, but they're not levered, and mortgages are not underwater. So where's the forced selling going to come from? In this cycle, the people that took on the debt and drove the market up was the government, and the government works on different economics. So they have a lot, they can hang out for a lot longer than any of us can. So that's why it's so hard to get that big flush out on the downside. On the upside, it's also very hard. You got high valuations, still concentrated portfolios, and there's no visibility. It's very hard to be able to plan. I think one of those slides that we have in the package is the how long it takes for these tariffs to take hold and for them to show themselves. So meanwhile, hard data is still hanging in there and looks actually pretty good. So you have this back and forth between hard data and soft data, and if the hard data continues to show it to stay strong, and I think Goldman now is saying 2.4 on the economy, the soft data is going to curl up, and more money will come into this market and just frustrate the bears. Does that make sense to you, George?
Yeah, 100%, 100%. Stav, we're not going to get into this. It would be for another time. I don't want to put the chart up, but I know when you and I were talking earlier today, you were making the reference to Stav. I don't know what's going on here. There's some glitching in your mic. I don't know if it's the app or it's you, but any event, it's always hard for active managers overall to outperform, but I think this is a particularly difficult environment, is it not?
100%. I mean, most of these managers, George, and you know this. You run, mutual funds and hedge funds. In the mutual fund business, you have to follow the SEC guidelines of being diversified. You can't own more than 25% of a sector, and you got strict guidelines. So how do you compete with a market that's so narrow in terms of the Mag 7? And when you look at the cash flow, these guys have trillions of dollars, right? And they're buying back their stocks, so they're fighting you. I mean, so it's very hard to outperform the market unless you take huge risks, and the SEC won't let you do that. So yeah, over time, active management has underperformed. That's why money continues to go into the ETF business, and becomes harder and harder to justify charging fees.
Right.
And the industry, it's more asset gathering than performance driven. It's all these mutual funds. So yeah, it's this is a tough tape. It's a tough year. It's hard for trend followers because it's very hard to see the trend. um, the only thing that's making money and makes sense to me is basically what your guest had come on a month or two ago, and you also said it's the great rotation. Money's still coming out of the U.S. It's going into uh, overseas markets that have been underweighted forever. It's going into gold, and that's the only thing I see that is sort of trending to the positive while the U.S. tries to figure itself out.
Yeah.
I think you pointed out to me about the Asian currencies, right? The Taiwan dollar's
Right.
going
So
up.
yeah. So I'm running a little behind stuff on the charts here, but
Okay.
I did put up on the nest. If you look on the nest, okay, I did put up, and it's Captain Obvious stuff now. It's all over the internet. But Louis Gave was the first one to put it out. It showed it's up in the nest. You can all see it. Record 1 day move for the Taiwan dollar. In sympathy, the other Asian currencies have also moved. Singapore dollar, Korean won, even RMB. And so the real question that Louis was starting to raise was, is this the start of something bigger? That was just my phone that rang. There was so much Captain Obvious stuff flying around all over the internet. Stavros, and maybe I should take a sidebar here for 1 second. You've taught me the difference between descriptive, predictive, and prescriptive information. Maybe you could just talk on that because it's one of the foundations. It's helped me verbalize, crystallize why I'm so annoyed with so much of the research that's out there, not just in FinTwit, but sell side research everywhere. So stop. Maybe you could talk a little bit about different types of information: descriptive, predictive, and prescriptive. That would be because I think that'll really help frame it for people the next time they see one of these, breaking thread. It goes on for like pages and pages, and the first 90% is rehashing stuff you already know. So maybe stop. You could talk about that a little bit.
Yeah, so I was taught by Walter Oxley, and his view back in the day, we all suffer from proximity bias. We always weight the things that are closest from time to region, the highest, and time is key. So our view was always everybody's focused on the next 10 minutes, the next hour. Back in those days, it was weeks. But when you look out a year or two, that's where the value is. That's where most people don't focus, and you can identify, the opportunities. What you want to avoid is people talking about what's already happened. I get so many emails, and you do as well, talking about the market was up last week. Well, how does that help me, right? We all know that. So you're describing what's happened. When you make a prediction, you basically take what's happened and you start making predictions, and that's where it gets interesting because now you're making sort of bets. And then when you prescribe, it means that you actually are telling someone or you're doing something. You're actually acting on that. So when you hear all this actionable insights, it's really somebody who's described what's the opportunity, predicting an outcome, and then explaining what to do about it, if that makes sense. So what we try to look at, and you and I have spent our careers looking, we want to look at the drivers behind it. It's the rate of change of what's driving the returns, and then how is the market positioned, and there's your opportunity. So that's kind of how we look at it. So when I look at information, I try to look at a chart. Is that telling me anything that I don't know or someone else? What's it predicting? Right? So my favorite charts are the ones where this is 6 months out or 5 months out. So I'll give you an example. Michael Howe has great liquidity charts, and they're always very predictive. Prior to Michael, it was the Mershalian K curve that Charles Gobb used to bring to us, and showing that liquidity always leads asset prices by 3 to 6 months. So that would be an example of looking at data that has some predictive value, and then you can decide whether you want to do something about it. So I find most people, and it's not they do it unconsciously or they're not trying to deceive you, but it's much more interesting for them to tell you what's happening with color, but in reality it doesn't really offer anything because you're not predicting anything. So when and you and I will look at these charts and we go, okay, what's predictive about this? What can I do with this? And
Yeah,
if it's
stop. Yeah, yeah, stop. Let me interrupt you there. It's a very key point, and I would ask everyone to really chew on that a little bit. So I tweet out a fair bit, but not as much as I could. I always ask myself, is this a Captain Obvious chart or not? Is this predictive or prescriptive? And by the way, just to differentiate between being prescriptive, predictive, and prescriptive, let's say for the sake of the argument, you come to the view. Okay, let's back up. Let's back up. Captain Obvious is, oh, the bond market is rallying. Bond prices are going up, yields are going down. And you have all these people on X and elsewhere. I don't mean to pick on X. The financial media writ large does it. CNBC, whatever. Oh, interest rates are going down. Bond interest rates are going down. Bond prices are going up. Okay. And in some cases, it's not like just reading yesterday's Wall Street Journal. It's like telling you, it's like reading the Wall Street Journal from 2 weeks ago. Okay, fine. Well, that's descriptive. Now we go to predictive. Okay, what does that imply about future course of interest rates? The Stavros was saying, what's the driver? It's the why, not the what. And you have many talking heads going on about the what. And I'm not going to mention names, as I'm reminded, one should praise individually, but criticize generally. And I would humbly submit for your consideration that most of the people doing all this, many of them, certainly on CNBC, let's say, or on mainstream media, but even to an extent on Twitter, on X, they've never run money before. And the reason they don't talk about the driver or the why is because they don't know what the why is. They just know the what. And that's why you keep hearing me rant on about Captain Obvious stuff. And it's almost like a race to see who can report first on the news. Breaking, and then you see like that repeated 100 times over. So the reason it's important to focus on the why is that, and you may not know why. You may have some ideas why, and you have to test those. And oh, by the way, we'll get into it later, Stavros. We're going to talk about Socratic method a lot because there's so many bloviating talking heads out there, especially on X. And I was thinking about recently some of the spaces where it hasn't gone quite as well. You may recall, Stavros, again, I'm not going to mention names, but in the space we did on Greece the other day, we had a fellow come in, and instead of asking you a question, making an observation, and then saying, "Hey, Stav, what do you think of this? What do you think of this observation?" He tried to recast the entire space. Resolved. Is Greece a failure or a success, or something to that effect? And I'm like, who the f are you? We're not querying whether Greece is a success or a failure. I'm going off the rails here a little bit, but I have to get this off my chest. And by the way, I do ask tons of questions. The reason people are on here is I'm pretty good at asking questions.
Where's
In fact,
Dilly to bring you in?
she's busy today, so that's
Okay.
why you gotta. We're not gonna show your picture, Stav, because it's gonna make people gonna be scared.
Yeah.
So in any event, people don't even. So people come in and they just want to hear themselves talk. And the fellow that came in the other day, and he's welcome to come in here, but he won't have the courage to. I timed it. It's funny because I think I eliminated it from the replay when he was mouthing off. He went on for 3 whole minutes. 3 minutes. And it's the line, no, is there a question? Is there a question? And then he was reduced to asking you such a lame question stuff. Oh, what's your opinion on Greek healthcare? I almost was thinking of having a rule for him and others like him, and I'm not going to mention names. Stop. What do you think of this? Not for everybody, because most people have manners and have reasonable EQ. What if I had a rule where, for the known offenders, it's like you make a statement, you got to ask a question. It's like when you go to candy, like give one, take one. Because it would drive these people crazy. They are so self-absorbed. All they can do is go on about their opinion. It's not a conversation; it's a speech. You know what I'm talking about, stuff.
Absolutely, and especially with the brokers or research people that you come through the office, and I always ask, is this your opinion, or is there some data behind your the drivers behind your view? And they stop, and some are honest that yeah, it's my opinion, which is fine. Opinions are fine, but they don't really help because I can't get to the data that's driving
Right, right. So
the
there's
other.
yeah. So
Yeah,
stop. It's again the old line, Jewish joke. Don't interrupt me while I'm interrupting you. You and I have been doing this for 39 years, like a comedy routine. All right. So stop. When you see somebody who is like 110% confident of their view, how does that speak to you? When it, when
well,
when
I don't mind. I don't mind that as long as I understand where they're getting their data and what's driving it. If it's just an opinion, we all have them, right?
right.
Um, there was a very good thing about Bernard Shaw about being overconfident and actually not knowing and being cautious. And the idea is that you want to find out, when people give you recommendations, what's their data. Go check it out. More often than not, everybody's quoting the same data, so it's almost like you're feeling like, oh, and then you go get the data yourself, and then you figure out what's how did they do it. There's some fantastic sites where you can get download a lot of the papers that people use, and it's free, by the way, and they give you all the data, and you look through it, and you see what hypothesis they used, and you start to
Right.
understand whether it's got value or not. Like for
And by the way, every boys and girls, ladies and gentlemen, women's in the room, Stavros is hilarious. I mean, there have been times when XYZ will come out with some research service, and then a couple weeks later, Stavros is like, "I just replicated it." I'm like, "How'd you do that?" "Oh, no problem. I just went on the Fed, Fred, or whatever it was, and it's just like, yeah, data's all there. It's free. You can get it yourself."
Yeah, the
Uh,
government produces the data. The Fed produces fantastic data. And data is getting more and more available and cheaper. Before we had to rely on Bloomberg, which is very expensive, and now there's fantastic data that you can spend a couple $100 a year and get pretty good data. So that's pretty good. And then I found that like the Social Research Network gives you all the academic papers you need on pretty much anything. um, so then you can figure out from there what they're looking at. I see a lot of faulty references like to 2008 and they did this time and that time. And all I know is every cycle is different and has different drivers. So the drivers in '08 were different than they are now. So therefore, the behavior is going to be different, right? '08, like I said, was a private sector problem, and the government bailed out the market basically, and the market took off. This time around, and my concern, and I'm probably bringing it back to today's problem, is that what happens when the government runs out of money? Who's
right.
gonna who's gonna bail them out? We're always
Right.
taught at CFA and MBAs that the riskless rate is the linchpin of everything. And now that I'm starting to see more and more is that's becoming under attack. Is treasuries really riskless at this
No,
point?
no, yeah, no, it's a risk-free
That's the
rate.
holy grail.
Yeah.
Um,
But by the way, Sal, before I get off the last point I wanted to make, I'm not going to mention names, but you know who I'm talking about. There was a guy who used to come in my space a fair bit, and you and I have known him for 35 plus years, and he had more than his share of outsized, variant perceptions and pretty good forecasts. But the problem was, as you pointed out to me, you described it as you often do. Problem is, we didn't know what the drivers were. It was like black box. It was almost like a random number generator. So the problem would be when it started to go wrong, we couldn't understand why, and then you're just totally left at the behest or the whim of his opinions, and we couldn't understand it, and it was just totally black box. You want to weigh in on that without mentioning names?
yeah, I mean the problem with black boxes is you don't know what the drivers are, so you don't know what risks you're taking, and you don't know whether this worked and then it doesn't work. We have this saying back in Greece when there's this monastery that pulls you up with rope, and as you're being pulled up with this rope in a basket, you ask when was the last time you fixed it, and it says, oh, when it broke, which doesn't help you very much because so it's kind of like the black boxes are like that, is that they work until they don't. The problem is once you lose confidence in something, it's over and you'll pull your money out of that quant fund or whatever. The best ones are the clear boxes, where you can see at least what it is, but you don't want to sit there and figure out how to replicate it. um, the kryptonite to these models and systematic and black boxes is novelty. When how do you quantify something that has never happened before? So we're going through uncharted territory here with these
So
tariffs.
yeah, yeah. So stop. So let me interrupt. Okay, so because we've had these types of conversations so much, you just triggered me. I remember. So something that's never happened before. So like Stav, here I'm gonna tee it up for you. It's like T-ball time. So like Stav, you mean like housing prices going down everywhere on a nationwide basis, like it did in 2007, 2008?
Yeah, I mean they are going down, but
You
there's
know,
not
no, forget about now. I'm just talking about why all those models blew up because something happened that never happened before. But that's what I'm
correct.
getting at.
They
Yeah,
they what they did is what they securitized them and they packaged them as AAA when in fact they weren't. And this is what happens when you have these opaque structures that nobody's seen before, and then you don't really understand the risk, and then people that are think they own something, but they don't understand the risk, and that's why it's so important to understand the drivers of what's driving the returns.
right, right. And also apropos of that, when you get into data mining and backfitting,
Yeah.
all types of things can happen. It looks good, but correlation is not causality. So again, I'm not going to mention names, but everyone's going to know who I'm talking about.
The other
Stop,
thing,
stop,
yeah.
stop, stop. Hold on, hold on. We're on the air, so don't say the name.
Okay.
No, when people do stuff like they issue award-winning papers because they're looking at the housing to no the lumber to gold ratio or whatever the hell it is, okay? And they back test it and reverse fit it and somersaults and then they start an ETF just at the wrong time. And listen,
Hmm.
hey, I'm going to go on record again. Nobody screwed up an ETF bigger than yours truly. So before any of you throw tomatoes at me, this is not about making fun of people. This is about being honest and forthright. Last time I checked, having bad performance is not a felony. Lying to people and being dishonest, that's another matter. Maybe it's a misdemeanor. But at any rate, when you do stuff like that and you fail and you have like these one factor models and you forget to figure out that, well, maybe you started your ETF at like just the wrong time. Like bonds, and we had what stop what I can forget what percentage of bonds around the world had negative interest rates, and you
You
had the
did.
10 year down
Yeah.
to 60 basis points. Like, what did you think was going to happen? All right, and then you get into this I'm right and the market's wrong type of mentality. So a process I think which is repeatable, transparent, understandable. Those are the critical ingredients. Anything that fails that test, no. And my father, but we both had professors for fathers. My father was a theoretical mathematician at Princeton. Um, I couldn't understand 90% of what he did. He specialized in algebraic geometry. He was a good personal friend of John Nash. For those of you that saw A Beautiful Mind, we knew the Nashes. My father would talk about how, why are we getting a 100-year storm every 10 years on Wall Street? Like, what's with that? All right, that's because it's done dishonestly or incompetently. All this modeling and everything, and I'm always reminded, financial markets are not like physics where you can model the equations. There's the element, this capricious element of human behavior in markets, the madness of crowds, and as you said, stop things that happen that never happened before. The quants can't figure that out. They're just not equipped for that.
Yeah. Well, the causation versus correlation. But was it Renaissance guy was from Princeton, wasn't he?
Yeah, another friend of my dad's. They knew each other from no, he was from MIT. So he was at Princeton. Not he was in Princeton. Wasn't at Princeton.
Uh,
He was at the NSA, National Security Agency. They always what I was NSA hired a whole bunch of guys who are experts in coding, and mathematicians to help with coding. And so Jim Simons was one of the first high frequency traders, I guess you could say. He
yeah.
went on to make billions and billions of dollars. And these guys were just theoretical math guys, and so it's just unbelievable and stuff. Your father you're also the son of a professor, no?
Yeah, he he was a socialist. He was in social policy and taught at the Graduate School of Social Work at Boston College. But the war experience shaped him because, like I said last time, he got into Stanford Aeronautical Engineering School, but he didn't go because he wanted to try to figure out how to make the world a better place so we don't have these wars. But we're still at it.
Yep.
Um, so yeah, so one of the other things I look at when I look at not only the drivers, I look at the time frame that the drivers are picking up. I've noticed this, and we'll talk about it, I guess, on the fifth. But I found that different models work over different times. One of the reasons why Renaissance did so well is they were trading a frequency that very few were trading. So there was so much inefficiency to be able to trade in and out, in and out. And when you're trading in and out a year, looks like 10 years for people who are long term. So I found that when I look at a model, also want to see what time frame of these drivers that they're using, uh, um, because then I can figure out. For example, if you're a value based investor, there's no correlation to your outcome over the next 12 months. It's just zero. But when you go out 3 to 4 to 5 years, value is fantastic indicator for future returns.
And by the
So
way, turning that on its head, and we're not going to get into a value growth debate, but it's true. It's been shown, and this really gets at the in the chaw of fundamental investors like yours truly. Momentum works as a strategy. If you do a simple thing about buying, whether you use a 12-month look back or whatever, over time it has tremendous alpha. But the problem is at the turns, and you and I go back so many decades on this, Stavros. At the turns, you get absolutely killed. You get a stock which has done so well, it's multiple standard deviations above its moving average, and then the car goes in reverse. And on a short-term basis, on a very short-term basis, those can be the best shorts in the market. So, but momentum as a strategy does work. I think the problem
yeah,
really is when you start mixing strategies up. Peter Lynch always used to talk about it. You have a discipline, whether you're a small cap guy, a growth guy. Okay, it's true. Certain things are just like values. That value basically disappeared the day the internet got invented. But that's a whole other story. But you got to stick to you got to stick to whatever it is that works. But momentum does work. It's
until
just
it doesn't, and then you have a large drawdown
exactly.
because everybody's caught in the same trade and they're trying to get out and there's no liquidity.
Yep, yep, yep,
And
yep,
that's
yep.
how this is what led to this drawdown. And I think we had done a chart together, was the toxic chart, where everybody was positioned long and everybody was buying into the Trump put, the deregulation, taxes, that this market's going higher. And then uncertainty index just took off. And when you have uncertainty and you have crowded trade, it's not the fire that gets you, it's being trampled trying to get out of the movie theater. So
Yep.
then that's what caused the drawdown. And now we're stuck now we're waiting. And as we started this call was, we have the hard data still hard. It hasn't caught up to the soft data, and something's gonna it's gonna happen one way or the other. And these V shape are very very hard to play. COVID was another one, was a V shape, down and up. And unless you have a process and a discipline, it's very hard to monetize because it becomes very emotional. And then when you start emotional trading, you end up, going to your heuristic biases, and that's why they say it's so hard to market time because you're running on emotional, and you're not being rational, if that makes any sense. So
Hundred
it's always
percent.
good to have a model to give you guardrails, and then you should always be looking what's new. And I know people say, well, it's what's new this time, but it is always something new because we've never had this before. We've never had 2025. So, you have to keep an open mind. So,
Right. So stop. Let's get back onto markets. How we can make money because we're getting kind of like a little softy here, a
yeah.
little too theoretical. Okay. So I did put up in the nest the hard data, soft data graph. Maybe you could speak to that a little bit. Explain what's going on here with the hard data versus the soft data.
Yeah. So the soft data is all the surveys you get. And basically it's just, people's expectations. The hard data is the actual numbers. And then you have other data, like on Friday, you had this employment data, which is kind of, I hate it because it's always being revised. Imagine, you come home and I got an A on a test, and then next week they say, well, it wasn't an A, it was a B, and you're like, what? you know, but for example, the number came in strong, but if you look at what they did for the 2 months prior, they revised it down by 58,000 jobs. So that's kind of a useless indicator, but people trade off it and understand it. So hard data is really, the what's actually happening. And I think we have another chart there. I think somewhere that Apollo did. I thought it was a
Yeah,
good
yeah.
chart.
Stop. Let me interrupt you. I just put it in the nest. The voluntary trade reset recession. Everyone can see it now. So if you want to speak to that, it's up on the
Yeah,
nest.
I do want to. So look, I grew up on Wall Street, not on Main Street. And on Wall Street, we visit all these companies and CFOs, and we ask them all these tough questions, and we know better than they do what to do with their business. However, when you go to mainstream, it's hard to run a company. It takes time. You own it. You can't buy and sell it. My boss used to say, "You buy a stock, you can sell it in 3 days. You get your money. You go out and do something else." When you own a company or you're trying to do a business, you don't get that. You own it. You're in there. So it takes months and months for things to run your business and to make deals and lawyers, and you have to test the quality. So I, I know Scott Bessett's supposedly a smart guy, and I'm sure he understands financial markets. But when I hear that they're using this, we're going to keep them guessing type thing, for tariffs, he's really hurting everybody because nobody can plan their businesses, and it takes time to implement, tariffs and optimize your logistics. And so the what I was trying to show with that slide is, and I think Apollo also had a couple other slides. It takes, several months before you can implement the new tariffs, and we still don't know what they are. Right? They still haven't negotiated them, so this is going to take years before all this gets settled down, and we really know what's going on. So trying to, understand in 60 days or less what's how this is going to play out. I don't think anybody knows, and I don't think that Washington knows either. They're just making stuff up as they go, which is fine. I'm just saying, but when you're running a portfolio, that's one thing because you can pivot, you have agility. But when you're running a business and you're owning something, it's really you're hurting it, right? You're hurting everybody because you don't know how to behave. You don't know what your costs are. You don't know who you should supply
Right.
your goods, your raw materials, and blah blah blah. So the point of that chart was this is really this is not the way to go in my view, and it's going to hurt a lot of it's not going to be
So
a quick
yeah, so,
fix.
okay. So stop. Let's get into this. So is the hard data gonna catch down to the soft data, or is the soft data gonna catch up to the hard data? And what's really interesting about this, I see people on both sides of the argument that I really respect, and I'm conflicted about this whole thing. I don't know. I mean, who we all love, eloquently has pointed out repeatedly, very clearly, that until you start losing jobs, um, by definition, you're not going to have a recession unless you lose jobs, and the job data doesn't show it yet. And I was listening to a Jordy Visser replay who we had in a couple weeks ago saying the same thing. Then you hear people like Michael Howe, who a couple weeks ago we had in here, who said, whereas before he was worried about a recession, I think you were in the space stuff, you heard it.
Mhm.
He's 100% convinced now we're going to have a recession. There have been other similarly smart people saying the same thing. So we're not. This is being recorded, but don't worry, I'm not going to hold it against you. Like,
No,
well,
I'll answer that question.
but if you had to,
No,
if you had to guess, what would you say?
yeah, my answer is I'm not an economist, and I really don't care if we have a recession or not. I like to know the companies I own or the investments, are they going to make any money, right? And whether we have a recession, by the time they declare it, you're already like 6 months behind, right? Stocks discount ahead. I just want to make money, not be right. So whether a lot of people spend an exorbitant amount of their mental capital trying to figure out the economy, and I think the economy is not the stock market, right? I did hear Jordy's thing that you sent me. Thank you. About Apple and Google, and yeah, these companies have a heck of a lot of capital. I think there's like $4 trillion of cash sitting on American companies, right? So I'd like to know what they're going to do with it, and I like to own them. Whether we have a recession or not, it doesn't really matter, does it, to the stock
No,
market?
and
So
that's the
why would
thing.
I waste my
And stop,
time trying?
and stop. To your point, when you're talking about data revisions, if we look back throughout history, what is it they talk about? I can't remember. It's not the BLS. It's the NCNERB, whatever it is, National Bureau, blah blah blah. They're the official arbiter of whether or not we had a recession, and half the time. It's 6 months after the fact they even realized it was a recession. It's almost like you got to go back and look at the video replay of the football game to see whether the guy stepped out of bounds or not. So,
Yeah.
like you say, by the time the refs have ruled on it, it's a complete waste of time. Just like in similar fashion stuff. What do you make of the canard Oh, we're in a bear market. We're officially down 20%. Do you feel better now that we're down 20%? I mean, who the heck needs that? It's a complete waste of time.
Yeah, think of it, George. When something's going down, something else is going up, right? I mean,
Most of the time, unless
yeah,
you get it.
we're in a relative world. When
Oh yeah,
gold
okay,
goes,
fine, sure. You mean like when we mean like when the
yeah,
value of money keep
valuation.
yeah.
So, our business is to make money and continue, to grow it. Einstein just keep compounding, so don't lose, in a bear market and go trying to figure out whether, I took economics. I was actually a philosophy and economics major, and I always learned from the philosophy that you think better with money in your bank account anyway. So, the economics was, I found, it's one of the most crazy uh, academic majors. I think it's a waste of whole. It's based on Marshall's analysis 100 years ago, and the theory behind it. If you look at what's driving those textbooks, it's just wrong. It's just based on wrong fallacies. So I don't really have a lot of time for economists, and it doesn't really matter because they're not managing a portfolio. I'd rather talk to a portfolio manager who's got buying and
Okay.
selling
All right. Now, now,
securities.
now now you got me fired up. In the same way. It's another problem with
Well, yeah.
social
What do I
media.
care about? Yeah, go ahead.
Yeah, no, another problem with social media and with mainstream media. Stop. I study the digital science as well. All right. But when you start asking economists for their stock market opinions or for an equity animal for their economic opinions, I mean, it's hard enough staying in your own lane and getting it right. But that's the other thing. They get economists out, and as you always said, the stock market is not the economy. The economy is not the stock market. I mean, people just forget all that, and they start with, well, my GDP's big estimate is bigger than your GDP, and my dot plots is bigger than yours, and da da
Yeah.
da 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 da.
Well,
Dude, like, what if it's already in the price, or like, what if there's a huge liquidity tidal wave of liquidity coming from Mike Heil, or whatever?
well,
People just make up these false constructs. It completely leads them astray.
well. I'll give you an example. For example, a couple of years ago, we had an inverted yield curve, right? And everybody was saying,
Oh God, I forgot about that one. Yep, go
yeah,
on.
and there's truth to the inverted yield curve. I get it. It has in the past. The difference is when you apply it in today's market, which is different than before. For example, when you and I started in the industry, most of the stock market, about 80% of it, maybe higher, was based on valuing fixed assets, hard assets like buildings and land and machines, right? And their return on capital. Today's stock market has nothing to do with that. That doesn't matter with the cost of capital because it's IP, right? It's Google, it's Apple. They're on a different economic model. So if you raise rates, it doesn't really matter, does it? So that's why the difference between a stock market that's not, that's changed. I mean, the stock market in 1880 was all full of railroad stocks. Well,
Hundred
how many?
percent, 100%, and that also brings
And,
up
yeah,
that
go
also
ahead.
brings up the fallacy of compensation versus other indices. So like I know this from doing farm markets for a long time, and you know this, Stavros, because you did international for a long time. You look at the composition of, say, European markets or the Japanese market or the Chinese market, any of these markets, they all have different industry compositions, and therefore, if you look at them from sector or factor perspectives, they're all different. They all have different drivers. So when you're comparing, say, the S&P, which is even now 30% plus tech, and as John Roque has correctly pointed out in the past, it actually got up to about 45% tech properly classified. And you compare that, contrast that with, say, the European indices, which are also a lot of banks and cyclicals. And I think once you get past SAP and a few other stocks, there's not a lot of tech in it, maybe 5%. It's so fallacious. People say, oh, look at the S&P. It's on, 25 times earnings. I'm just making numbers up. But of course, there was a premium valuation. Believe that out for a second. Look at the S&P's on 25 multiple, and Europe's on a 12 multiple. So sell S&P, buy Europe. You have to factor adjust, and you. I'm sorry, you have to sector adjust. And people just, I mean, the amount of, I don't know, Stavros, what they call it, sloppy or dishonesty or whatever. I mean, this is the stuff.
No, you know what it is George. The Wall Street's run by compliance people now, and they're you don't want to get sued, so you basically I always get this. Well, you can't time the market, so we don't do all this tactical. And then my response is, well, if you don't time the market, then what am I paying you for? Like, you want a long term model? I can get that off the internet, right? And buy Vanguard ETFs and just, okay, we're done. Like, what do I need an advisor for and to pay
You
them?
know.
So
Well, then there's another one too. People say, well, if you had missed the six best days in the history of the stock market, your returns would be, bupkis, right? Yeah, and what they don't tell you is if you'd missed the worst 6 days of the stock market, your returns would be like 5x what the market was. I
yeah.
mean, it's just such hokum. It's insanity. All right, stop. Let's get on the current markets a little bit more. Okay, so I don't know.
Anybody have any questions?
Well,
Maybe
yeah, we'll
because
get
you
to
and I could
that.
talk forever. And
I know you and me both. This is dangerous, but you know what? Strangely, this room has actually grown in size, so we must be doing something right. All right, watch. Everyone's going to leave now. So
yeah,
let's get on to some current topics.
we're running out of spaces. Go ahead,
No, no,
Jeff.
no, 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 no. Okay, okay. So I'm just going to pick one. I don't know. We got so many things we can talk about. All right. So let's talk about the currency move that we saw. All right. Again, this is maybe Captain Obvious, as discussed by various talking heads, almost every talking head I saw today, with one exception, Louis Gavkow, who's been in this space. By the way, I'm going to make the announcement right now, Stav, because I've been you know me, I'm terrible with computers, and and you've been hassling me to get the announcement out, and I just haven't. So, I'm going to be more explicit right now. I told people, watch this space coming soon to a theater near you, blah 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 blah. Well, with my computer skills, we'll be waiting years for this to come out. But anyway, I mentioned to people June 5th. Save the date. All right, I've said it a couple times. People want to know what's going down. Okay, so on June 5, Thursday, June 5, we are having a virtual conference, an online conference. This is a paid conference. I actually believe this is going to be perhaps the greatest conference ever achieved, ever assembled. And the reason I say this is because of not because of me, I got nothing to do with it. It's the speakers. And most all these speakers have been in my space before on YouTube. And I will challenge anyone to tell me a conference that's better than this. Because as opposed to most firms that put on conferences, they're held hostage by they have to use their own internal people, and they may have some great analysts, but they're not all great. This is sort of like Stava, you said it's Jordan Noble's All Star team. So we will have the following on global strategy. Jay Pulaski, who was in the space a couple weeks ago, really really liked. Return on Europe, return speaker Ian Harnett of Absolute Strategy, the leading European investment strategist, and I think ASR maybe stop. Are they like the number one strategy firm in the world, or certainly in Europe? Is that
Yeah, they're rated like for 13 years in a row the number one independent
yeah,
research. They're
exactly. Okay,
external
okay,
guys, and they're very good
great.
at it.
Okay, on global tariff wars, we're going to have Louis Gov. Requires no introduction. On global liquidity and the global capital wars, we're having Michael Howe. If you want to learn about AI and Bitcoin and the digital future, we're having Jordy Visser. And this is Murderer's Row. This is like the 27 Yankees. On gold and precious metals and the latest macro themes, we're having Tavi Costa. On energy, we're having the number one energy analyst in the world, 40 some odd years, been going to the Geneva OPEC conference, Mike Rothman, formerly of Merrill Lynch, Bank of America Merrill Lynch, now Cornerstone Analytics. Then we're having some guy tracking investment conditions. You know this guy, Vestmo Global Research, Stavros? I'm not. Who is this guy? How
He's
did he
an
get in here?
idiot.
This must be a
He's a
typo,
complete,
Stavros.
he's a complete idiot. You got to have him there to make the other guys look good.
Exactly. Well, you know what? You know what? The only good thing for you is that I got you go before John Rook, not after.
All right, that's
The,
good.
the next speaker one of my favorite technicians. He's been a regular. You all love him. Is John Roque. And then finally, for something different, one of the most renowned short sellers, and he's always a hoot, Mark Cahotas. So again, this is going to be Thursday, June 5. Pulaski, Harnett, Louis Gov, Michael Howe, Jordy Visser, Tavi Costa, Mike Rothman, Stavros Iatridis, John Roque, Mark Cahotas.
And that's all
This,
virtual, right?
it's all virtual. This is a paid conference. We'll be getting our Substack up very shortly. You'll be able to register. Replays will be available. It's going to run for 7 hours or 8 hours, so I don't expect everyone to sit through it the whole time. But again, I will put this. I think this is. I don't mean to be arrogant about it, and it's not about me. It's about the speakers. I mean, I will just tell you the speakers, when told who else they're on the panel with, on the conference agenda with, they're like, "Oh my god!" And one of them said, "Gee, we've been meaning to do something like this for years. We never did it. Kudos to you, George, for putting this together." And so, this will be a
You
fantastic,
told everybody you want actionable ideas for each of these guys, right? I mean,
hundred
we want
percent.
to make money. We don't want
This
to
is not
not
about this is
lecture. No,
this is not about a macro
lecturing not
lecture.
allowed.
Yeah, this is not about a macro lecture. My is bigger than yours, or gee, I know that the U.S. has been in a recession for a year. Nobody knows this except me, but take it from me. And or we're gonna have a debate about whether the dot plots are this or that. This is actionable ideas. What's new, what's fresh. Okay, so I'm hopeful that everyone will come away with some actionable ideas from this. Uh, the price point has been set in line with other virtual conferences. And again, I forget the exact number. I got to even go find. I can't even remember. It wasn't a huge number. But at any rate, this should be again just a fantastic conference. So yes, I'm shilling, but I don't think it gets any better than this. So Stavros, I'm looking forward to you explaining in some greater detail on the fifth how exactly it is you do you
Yeah, I
work
want
your
to talk
magic.
about the different drivers that generate decisions and signals and give examples so people can in other words, clear box, no black box,
Correct.
and
Okay.
what drivers have worked over different time frames, and then what are they saying about today, tomorrow, and the more in the long run. So yeah, I'm
Okay.
excited and look forward to that.
All right, so stop.
Thanks
Let's
again,
talk about
Mike.
another. Let's talk about another anomaly in the market right now, which is kind of making everyone crazy. You've seen this big decoupling between um, bond yields, which have been
Hmm.
going up, and oil prices, which have been going down. And I think uh,
Again, yeah,
okay,
this is
so
what.
like that. That's not. They again. They told me that couldn't happen. So could you talk on that a little bit?
Yeah, and again, this is again the novelty aspect. We haven't had, so what's driving the market is everybody's saying, oh, the 70s, the 80s, it's the 30s. We never had a tariff driven market, right? And back in 2019 and 20, like I told you, that was a health driven cycle, right? It was COVID, and it was a virus cycle. This one is a tariff cycle. So the bond market's reacting to so not so much oil. In the past it would have gone up, right, because oil's going down and it's pretty straightforward. But because they've disrupted the world trade, we don't know what inflationary, because obviously they're going to pass through all the costs to the consumer. We just don't know what inflation's going to be, and then and then we don't know how much of the deficit. So there are two things driving bond yields. One is the government deficit and why people elected Trump to begin with, because it was getting out of hand. And two, the tariffs are inflationary because it's a tax on final consumption here in the states. Who pays for it? We can argue, but at the end of the day, price will probably go up. So that's why it's not reacting to the energy price as it should. Does that make sense, George?
100%. So stop. You got. Despite, I mean, gold is going up. I mean, all right. Let's talk about gold against oil. Okay, so another one of those charts. Oh, how many ounces of gold does it cost to buy a barrel of oil? And gold is way overpriced relative to oil and blah, 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 blah. Okay. People doing that on silver too, gold, silver.
Yeah.
So speak on those, Stavros, those relationships. Like they work until they don't.
Yeah, so gold. We started a gold hedge fund in 2002, and I wasn't excited about it because my boss at that back in the 80s was Walter Oxley, who had made a lot of money with gold in the 70s, and you pointed that out, and how gold was really did well in the 70s. The problem again is the government is they're printing money, or they're out of control, and gold is basically the real asset that is basically the constant. It's the paper is being printed more and more, and that's being devalued, and gold goes up as a function. It's not so much gold is going up; it's like paper dollars are going down. If that makes
Exactly. Exactly.
because
Exactly.
so gold is just reflecting I think a constant. It's it's the more papers to buy gold. When we were doing the gold fund, we had an investor. Tech guy out of Boston, and he said, "Yeah, I get it because when I went to Yale, it cost X dollars for the same room, and now my son went to Yale and he paid, X plus X to get that same room. So it's just more pieces of paper to buy the same thing. So to me, it's gold is sort of a constant. It's how much do they print, and they're going to print will determine the price of gold."
Right. So staying with paper money in
Mhm.
that theme, and I want to get some questions in. So I rest these up. You'll have a question in a second. Maybe some others will come up with some questions. Although I don't know, people want to just listen to us prattle on.
Good.
So stop. We saw this big movement in the Taiwan. And I started to go down this rabbit hole, and then I interrupted myself with the Louis Golf thing. Whatever. So we saw this big movement in the Taiwan dollar the last few days, and in sympathy, the Korean won's moved, Singapore dollars moved, the RMB's moved, and so again, going back on Captain Obvious from First Order Thinking, some people are saying, "Oh, gee, this is look at this big move, like with no analysis, no predictions, no prescriptions." And then some people say, "Well, the reason this happened was because the life insurance companies have these, trillions of dollars or hundreds of billions of dollars of foreign asset portfolios, predominantly U.S. Treasuries, and they were unhedged. And the central bank did not step in to stop the Taiwanese currency from appreciating. And this is really bad for the life insurance companies because they're going to take big losses now on their foreign asset portfolios." Okay, that may be true, but is that really the story here? Is that what's important? And what I want to kind of kick around with you, Stavros, a little bit. We've talked a lot in the past, you and I, about the dollar and how all the capital came here to the U.S. It's not limited to, but including Asian investment portfolios. In this context, the Taiwanese life insurers. And everyone loves a free ride, buy the U.S. Treasuries, get a yield pickup, don't hedge them, blah 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 blah. And as you would say, Stav, it works until it doesn't. So kind of begs the question, as my grandfather always used to say, don't ask a question you don't know the answer to. But I look at this and I'm like, whoa, wait a second. How many other non-U.S. investors have exposure to the dollar? And the force has been with them. It's been a tailwind the last umpteen years. And all of a sudden, if you have that wake up call where, oh, wait a second, this could be a problem. So you might either want to sell some of your U.S. Treasuries, mute yourself, stop. Sell some of your U.S. Treasuries or hedge your currency. And what does that do either to the value of the dollar or to U.S. bond prices? So I guess I would call this a thin read indicator. Like, watch this space. So to me, the real potential importance of this is that story and what it means for U.S. asset prices, our currency, Mag 7, all that kind of stuff. Meanwhile, you have reporters, and I'm going to use it in a pejorative sense, all the people you should delete on Twitter who were just saying, "Oh, look, the Taiwanese yuan had its biggest one-day move, 7%." By the way, you know what the hilarious thing was, Stop? Because it's quoted the other way. I mean, because the yuan went from like I don't know, like 30 and change to 28. Some knuckleheads initially put out the ones going down. It's the other way around. It's how many one you need to buy a dollar. So can I shoot myself now, Stav? Any thoughts, comments, or actions by any of that?
Yeah, Trump is the driver, and people are bringing their capital home. It's tactical, in my view. I think of it this way, George. If you and I came from another galaxy, and because we inherited $10 trillion from our human uncle and just cleared probate, where would you put $10 trillion? Right? Forget about a million or two. That's easier. You still have the U.S. is still the place to put your $10 trillion. Where else would you put it? China? I wouldn't. Russia? No. Where would you put it? And I think so. The dollar, I think, still will hold its reserve. However, it was a crowded trade, and you're right, and that is unwound, and all of a sudden. If you're a European, you're not only did you lose money, on the bonds going from 0 to 5, but you also lost it on the currency. So that's a big hit, and that creates reflexivity, and of course it's a positive feedback loop. The more you lose, the more you pull. The more you pull, the more you lose, type thing. So I think there's and I think your other guest had pointed out, Jay, and it's the great rebalance, right? The great rotation.
Right. And by the way, I had to look up where the quote originally came from. I know Chuck Cloud, the great investor, Boston-based investor, who formerly I first met Chuck when he was a global investment strategist for Merrill Lynch. He would recite this line: "Capital goes where it's treated best." And I don't. I'm looking on here. It's saying Walter Wriston, the former
Citibank.
CEO of Citibank,
Yeah.
came up with that line. Which, by the way, for all you folks out there reading the talking heads on Twitter, I love all these geniuses who rip off all these quotes without any attribution. It's
There's
Walter
no
Wriston.
patent, and George, there's no patent law in our industry.
I understand, but it was Walter Wriston. Just like, for instance, for quad investing, the quads, the quadrants, the quads, right? Stop. If we want to go back 30 years, started talking about that investment approach. Stop, you there?
Yeah, I'm here.
Yeah, remember David Bowers with the investment
Yeah,
clock?
yeah,
Merrill
that's
Lynch?
yeah.
Okay, and then
Well,
and
the
then and
guy
then Gov
speaking,
and then Gov
ASR, Ian
and then
Martin.
Ga-
Yeah.
and then Govcal, Louis Gov's father, Charles Gov, was still around, who I will have in a space one of these days. He is the one who invented the four quadrant investing thing. Okay, but people just rip this thing off without any attribution. I mean, it's just sheer dishonesty. This is the way it rolls. I'm not going to mention any names. Rusty, thoughts, comments, reactions on that or anything else, Rusty?
I'm laughing at that. I do have a question.
Why would you be laughing, Rusty? I'm sorry.
just, I just love your figure. Sorry, you caught me mid laugh. Your delivery cracks me up.
So, Rusty, I caught you unawares. What part of any of this nonsense we've been talking about for an hour now do you want to give a comment on, question on, weigh in on? Are you offended by, triggered by anything? What's on your mind?
My question is this: you guys are veterans. Known each other a long time, and now you're kind of living in parts of the world. I am looking at oil dropping. Right, rates are doing what rates are doing. I'm trying to figure out, all right, so look, we know what happens. Oil trades, rates dropped, the dollar weakens, everything like that. So, how do you see this cheapening oil playing into the mix of everything? I know that's a loaded question, but if y'all could just kind of speak on that.
Yeah, I think I have a view is that this is part of the Trump administration's plan, right? You want oil to go down because that'll bring yields down. They have a funding problem, right? They have to, they need rates to go down. If rates don't go down, they're screwed. So the way you get rates down is you get, oil to go down. And it's like, what was that? The guy from Clinton's got James, whatever. It's the
Yeah,
economist.
yeah, yeah, yeah. It was James Carville. Yep. Go
Not
ahead. Yep.
only if oil goes down, you're also killing Russia, right? Because Russia depends on oil, right? And we used to have an index where oil goes down, terrorism goes down because they can't afford, they can't finance themselves. So, so oil is I think part of the. That's why he said when he got elected, "Drill, baby, drill," because he wants supply to go up.
And stop. You forgot Iran. You got to throw them in the mix too.
Yeah. So Iran, if yeah, well, that's what I meant by terrorism. Is
No, you
that
mentioned Russia, but you get two for the price of one. You get Putin and you get Iran. Go ahead.
yeah? So when oil goes down, you check off a lot of boxes, and so the consumer in the U.S. is it's deflationary, and that gives them more money, especially in Boston and other areas like that. You get Russia, you get Iran, and then the Saudis get discipline, right? Because they're the low cost producers, so they wipe out a lot of production. Is that does that make sense?
No, no, it does. I'm just thinking of, okay, look, all right. So if we have rising prices due to all these tariffs, but you've got this false sense of security in a cheaper gas tank, I'm trying to think of a macro picture here, right?
Yeah,
Uh,
Rusty. Um, Mike Rothman, who I defer to him. I mean, counting barrels of oil is a thankless task. I'm trying to pick the oil price is a thankless task, but I've read him over the years, and I'm reminded. I don't have the graph in front of me, but if you look at energy as a percentage of consumer expenditures, it's like absurdly low now. I want to say it's down to like 3% or some number like that, compared to maybe 6% a few years ago, and maybe 9% at its peak or whatever. So the price of oil, going down has become the price of oil has become so small relative to everything else at this point that, I mean, to Stavros' point, it adds more spending power. But you got other things going the other way. So, for instance, I was reading something on car ownership. It was something about yeah, it was, yeah, I know what it was. They're talking about the price of oil, and then they were saying the price of oil, and Russ, you'd appreciate this, has become like, in real terms, gone down so much. And then you look at the cost of car ownership, where the average car now transaction price is $48,000 or something crazy like that, and insurance costs are going through the roof, and repairs and all this sort of stuff. I mean, to Stavros' point, the cost of everything else is going up so much that, energy, to the extent that they can, have our friends in the Middle East, notably Saudi, help with this. It's one of the few levers they got. So I think Stavros, that's what you're saying. So Rusty, what I'd ask you, since I think you're from Texas, is that right, Rusty?
Georgia.
George. All right. Well, maybe you're not the right guy to ask, but maybe because you asked the
There's
question.
an Athens in Georgia. Yeah.
Yeah. Okay. But yeah. But maybe it's on your mind. Like I read some stuff recently, and they were talking about. I forget. And we got TX Kitty in here, who is from Texas, and he knows a lot about fixed income. So actually, you know what, Rusty? Forget about you. My new friend's TX Kitty. TX, how you doing, my friend? Good to see you. You there?
Uh, yes, I'm here.
Good.
Hi,
All right. So
George.
so so
How are you?
TX. Here's the question I want to ask you. Can you talk a little bit about the junk bond market and energy companies? And I was starting to read that people are worried that if the price goes down much more and folks aren't hedged, you could see increasing defaults, yada yada yada. Or is this really not something to be worried about right now? Because balance sheets in the energy sector are relatively okay. TX4 is yours.
Uh, well, to start off, I mean, the grandiose 4D chess plan of the White House uh, to bring the price of oil down is fine, even though, I mean, oil has gone from 60 to 50 to, I don't know, 50 or even lower. And as far as the gas at the pump down here in Dallas, it's still above $3. So we're not seeing, at least not here, and I suppose not in other states, commensurate decline at the pump. On top of that, you got to be careful what you wish for, because if you bring down prices too low, The ex CEO of Pioneer, which was sold to Exxon, recently said that most of the PDP reserve, which stands for proved developed and producing reserves, so essentially the stuff where you can just open the tap and you have the oil gushing out. You don't need to drill, you don't need to spend any capex. Uh, so those are P1 reserves. So he said they are running very dry, and that's kind of understandable because the decline rates in the back end and in the shale are extremely steep, like 40% year one, 30% year two, and then next to nothing. So it's really very front end loaded. And at current prices, it is for sure that companies are going to go out of business, so they're going to bust their covenants. They're going to need more capital, whichever way you want to frame it. Obviously, the big one, the majors, I mean, there's no need to worry about them. But for the mid-sized companies, some of which are trading like SM Energy or some others that have a decent amount of leverage and where the price actually matters. And there is a host of private companies, both on the E&P side and the service side. I mean, drilling in the back end at sub $60, that's just not economical. End of story. So, yes, companies are going to go out of business or they're just going to stop producing. So the drill baby drill of out of the Orange Man, it will be in Saudi Arabia, but not in Texas. So that's my reaction to that. The only other thing that I wanted to throw is that I actually spoke over the weekend with a guy who was sometimes on your on your space. He's super smart. He's actually running real money, like several hundred million money. And he was telling me that there are huge bets currently being placed in what the Fed is going to do or not do. But they're not being placed in the bond market. They're being placed in the 3-month futures contract called SOFR, which is the old euro dollars, which is essentially betting or as to what the Fed funds will be at that time. And they go all the way to whatever, 2026, 2027, 2028. And there are huge bets, and the moves are pretty violent. Like Thursday, following the ISM, and then on Friday with the not so crummy job report, the implicit move in the 3-month rate for starting in January 26, or end of December 25, it moved by 40 basis points. That's not the kind of thing you see in the paper, or even if you look at the two year note, because even though the 2-year note has gone up at the trough of 365, now is at 385, there are huge bets being placed. Uh, why? I don't exactly know, because, as you said, the hard data so far has been holding up. So even to my surprise, I would have thought that we would have serious job deterioration. But as long as the hard data is where it is and the official inflation PCE is way above the 2% target, there is no way that the Fed is going to cut. No way. And the S&P has gone up 17% from the lows.
So
17.
it's the TX, the TX. Hold on, I'll make sure I understand something. These guys are making big bets that interest rates will go down. Is that what you were saying?
Well, big bets. Bottom line, I mean, on the side of some of them are long, some of them are short. But they are
Okay.
what I'm saying is that they are very sensitive, because on the back of the not so crummy ISM and the job report, which was, well, I can't remember, 177 instead of 150. I mean, nothing dramatically or in terms of the expectations. The contracts, which is the December 25, which is, I don't know if it's the white or the blue, I can't remember the colors anymore. But the expected 3-month rate starting in January 26, which is the Jet 26 so far, moved up, not in price, or it moved up in yield
Yeah, that's
by.
what I think the yield went up. Okay, yeah, go on. Yeah,
So the implied yield, I don't know what it was because I
yep,
don't really follow that. Let's say it was at 340.
yep.
Now it's at 380. Uh, so in other words, all the short end has repriced higher because anything at the short end for the banks is it's like the hamster in the spinning wheel. If you're buying stuff at a rate that is below what you're funding out on a daily basis at the Fed, you need those rates to come down and to come down fast. Otherwise, you're just losing money on a daily basis. It's very simple. If I tell you today, George, I'm forcing you to buy a 2 year note at 3.5, and there is only 2% chance that the Fed is going to cut over the next 2 years. Well, you have 99% chance of losing money because it's a negative carry. And when you buy a 2 year, by definition, the maturity of that paper shrinks pretty fast. In 6 months, it's no longer a 2 year, it's only a 1.5 year piece of paper. And if the Fed still hasn't cut, well, you kind of screwed because you gave away all the negative carry. So it's just to say that I think that the market is pretty attentive and on its toes, looking for the word or the sign that actually they're gonna cut for whatever reason. And I think well, Powell said it pretty bluntly and pretty openly. I mean, at this point in time, there is no tangible reason whatsoever to
Right.
cut.
Yeah, TX, you say that very well, and you mentioned in the space a couple weeks ago, you thought they might cut anyway because, as you referred to, you need the yield curve, otherwise, it you in order to fund the positions. So it makes sense. So let me ask you this, TX. Let's assume, um, okay, let's roll forward a little bit. Okay, let's go forward a couple months, whatever, 2, 3 months, and assume the economy hasn't boomed, but the bottom didn't fall out. We don't have a recession, and let's say the Fed cuts and they say, "Oh, it's an insurance policy," blah 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 blah. How do you think the bond market would react? Do you think bond yields would go up or bond yields would go down?
Well, if they
Long
cut
end.
for no tangible reason, being inflation really having gone to the target, or more importantly, employment or lack thereof signing red. If they cut for no specific reason, I think the long bond, I have no clue what it will do, to be perfectly honest. It could go up in yields like they did last time when they cut for no reason and they cut too much, and the long end puked big time for a year because they went over their skis in terms of cutting, or of cutting and cutting too much. And you might have the same kind of vomit essentially because the long end of the bond market are called, as you know, the bond vigilantes. If they think the Fed is kind of doing the wrong thing and again going back to the old okay, let's cut rates, let's go down to zero, let's print paper out of thin air. Yeah, the long end of the curve is not going to like it at all.
They-
Especially now that you have antagonized, and I'm not going to get into the debate of whether it's for good, it's for how long, and to what extent. You have antagonized a portion of the buyers of your debt. How many, I don't know, but some for sure.
TX, when you say you antagonize some of the buyers, you referring to people who are on the left? You referring to the foreign investor?
No, 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 no. I'm referring to the because you only talk about I mean, people only talk about China.
No, no, TX. It's all the foreign TX. TX. It's all the foreign. Are you talking about the foreign? It's all the foreign. Europeans, Asians,
Yeah,
everywhere.
yeah, yeah. And actually, on that front, there is an article. There was an article yesterday in the journal by the head of the Norway Sovereign Wealth Fund. So the guy is running, I think, 1.8 trillion. It's the largest sovereign wealth fund in the world, and he was just kind of giving general comments. And he said, we could very well have a situation in the US where things do not go right and the stock market loses 30%, where bonds go up in yield. I mean, this guy is obviously very smart and knows what he's doing, but he was not like super sanguine. He said there are possibilities where things are not going to be so rosy. Uh, and just to come back to the foreigners, I actually took a look because I used to deal with them. If you just take the central banks of Indonesia, Malaysia, Thailand, the GIC, Government of Investment Corporation in Singapore, MAS, Monetary Authority of Singapore, HKMA, Hong Kong Monetary Authority, and the Central Bank of South Korea. If you take all those guys that nobody talks about because it's always China and Japan, they have 3 trillion of reserves. Three. So I'm not saying they're going to dump them, but you have antagonized a lot of people, whether they, and so to a certain extent, some of them are not going to come as willingly. I mean, maybe they're all going to come back and they're going to continue to buy treasuries. I think you've pissed them off to a certain degree. And they also need dollars to buy treasuries. And if you cut them off by putting high tariffs where they're not going to be selling any stuff to the US and not going to have the dollars, well, they're just not going to have the money to buy those treasuries. It's pretty simple. So
Right.
anyway, it's my rant for today.
No, well, I'm not gonna let you go. I always love hearing from you. Takes one other question for you. Hold
Oh
on,
yeah,
guys.
the last thing that I really do not understand, and I think Ryan was here and was super smart might give an answer. So the stock market has rallied back like the S&P like 16 or 17%, and yet I've reposted. There is a 3-minute interview of the co-CIO of Oaktree, who's probably not a stupid guy. And he's talking about private credits that are being shown to them at
Howard, yeah,
50.
Howard Marks. Yeah, okay, yeah. Go on, keep
No, no,
going.
not
Yep.
no, not Marx. The
Somebody
guy
else.
who
Okay,
works with.
okay,
Yeah,
go on. Yep.
I put it. Actually, I sent
O-
it to you.
Okay.
So it's very quick to listen. Three minutes. So they're receiving offers to buy stuff at 50 cents on the dollar when you know that those things are generally they're not traded, but they are priced at like SOFR plus 500 or plus 600 because it's pretty levered. So let's say it's 10%, give or take, on face. So they are being proposed paper at 20% yield. So evidently something is is going on, something is off. Either the underlying companies are in the tank and they've busted their covenants, they need more equity, the private equity guys don't want to put the equity, or maybe the LPs of those structures or the holders of the BDCs, which is the public side of those private investments that we talked about in the past. Maybe the guys that own that paper, they need liquidity for whatever reason. I don't know. I don't know if it's the underlying companies that are really against the wall, essentially at the verge of default, or the owners of the papers that need liquidity for God knows what. But you cannot have a stock market that goes back up 17% and some private debt, or even not private, trading at 15 or 16%. Something is off. I don't know why, what exactly, but something is off.
Right. And one more question for you, Tix, before you go. What are you seeing more generally in the junk bond market with respect to is it what signs is it giving off about the economy, i.e., people look at spreads, idiots like me who are just dumb equity guys. We don't really we know the indices don't always tell the story and you got to look under the hood, and you're the
Yeah,
smart guy because you look at individual names. So is the junk
yeah.
bond market still pretty optimistic about the economy when you look at the prices and where spreads are?
Well, I'm not going to give you a very good answer. I'm going to tell you that the corporates that I bought 4 or 5 months ago, they are either flat or up in price because they're all pretty darn solid. Like, even to give you an example, Occidental Petroleum, you would think that the spreads have widened quite a bit. But on the stuff that I bought, which is like 3 year, 2027, I mean, first of all, it's one of the first maturity, and you are senior to Warren Buffett. So the price of oil can go down another $5. I mean, that bond is not gonna move. So it's really credit specific. Like, I own some Philip Morris paper, 3 or 4 year paper. It hasn't budged. SBA Communications, which is the tollway for the cell phones, that stuff hasn't budged. I don't even know if they are rated. I don't care. It's really name specific. It's really name specific. So I wouldn't be able to tell you. Yeah, I'm sure there are some baskets that have done worse, probably the Oilers in general because of the price of oil. But it is name specific at the end of the day. Oxy, I mean, again, you are senior to Warren Buffett. That's all you need to know. Um yeah, so yeah, things have widened. Some things that are obviously more levered to the economy as well. But yeah, it's always name specific. At least that's the way I look at it because I just buy specific issues.
Overall, things are pretty well behaved, is what you're saying.
Uh,
Yeah.
yeah, well behaved for the companies that are solid and that are still generating EBITDA, that are not 6 times levered, and that are not, well, they're not going to bust their covenant if their top line goes down 10%. But I'm sure there is a lot of crap that is not well behaved at all, but I just don't look at it.
Stavros,
Dirk,
you
can
got
I?
any thoughts on this?
Yeah, I just to give my 2 cents on the liquidity and the private equity. So many years ago, a lot of these institutional investors put a lot of money in the alternative space, private equity, private credit, and they they went very high in their allocations, and they became very illiquid. They were worried that they were very illiquid. And then what's been happening over the past several years is that money has not been given back. So their cash flow has been, and so Goldman was raising equity in private credit funds to give them loans off their private equity investments, if that makes sense, because they had a liquidity. So the issue is with the investors, not so much with the underlying. And then what happened was with Trump kicking off these endowments and the research grants and whatnot, they become illiquid, so they need capital, and that's one of the reasons why they're asking 50 cents on the dollar, if that makes any sense.
Yeah, because those structures, just to remind people or people who don't know, whether you're talking about a typical private equity fund from Blackstone or what have you, which is private equity, or you're talking about a private credit fund, which is essentially a pool that's going to buy loans or bonds of any kind. Those funds, for the most part, have a lifetime of between 7 and 10 years, and the docs generally allow the GP, in certain conditions, to extend the life of the fund by 2 years. But once you go beyond that, if there is no liquidity, for all intents and purposes, the GP cannot give you the money back because there is no way for him to get liquidity on the paper, because if the company has not listed, or if the bond is not trading, or if nobody wants it. So that's why you have, actually, I dealt with that back 4 or 5 years ago. You have shops that specialized in secondaries of funds, or secondaries
Correct.
of
Right.
LP interests. And I can tell you, at the time we were just trying to sell some stuff that was had done very well. It was a private equity name. It was just a single company. But I mean, the bid ask is like 15 to 20 cents apart. I mean, that stuff, it really trades by appointment. And if you really want to sell, you're going to have to give up quite a bit on relative to par. I can tell you that.
Yeah, TX, before we go to another question, I just want to follow up on that. And we talked about this thing a couple weeks ago. So recently, and I know you're aware of this, a number of high profile institutions have expressed an interest to sell some of their private equity. Yale University announced they reached an agreement to sell, I believe, $6.1 billion, which may be as much as 40 or 50% of their private equity. It's a huge number. I think the
Indeed.
total private equity exposure is maybe 12 billion out of a 41 billion dollar portfolio. And there's speculation. It was rumored that it was at a 10% discount, which my reaction when I heard it was, oh, that'd be a good price for it, only 10% off.
Oh, yes.
Yeah, moving further afield, you look at Harvard. We're talking now. We're not talking about the fireman's retirement fund of Peoria, Illinois. These are supposed to be the brightest guys in the room. But the problem is, they all followed the David Swenson endowment model. As
Yeah.
I'm reminded, I think Warren Buffett famously said, "What the wise man does in the beginning, the fool does in the end." And so Harvard, I was absolutely shocked. Harvard has 40%, I believe, 20 billion of 51 billion in private equity.
Oh,
Okay,
yeah.
that's not to mention venture capital or private credit or any of this other stuff. I'm going to call it crap, which is what it is. Um, what you mentioned before, secondary market for this private credit? I'm sure you have some knowledge of what's going on in private equity. To me, this sounds like a huge problem. I mean, I happen to have gone to that school in New Haven, and I can just tell you that when I look at in the social media, on the Facebook page, and so on and so forth, the alumni have no idea that the assets are not worth the paper they're written on. And so I'm just,
Yeah.
I mean, when you
So,
see,
so, so
so
the,
hold on, let me just finish.
yeah.
I'm going to speech and a question. Sorry, I'm allowed to do this.
Sure.
So Harvard University, which supposedly has a $53 billion endowment, 53 billion with a B, they announced, I think, a bond issue of $750 million. Well, wait a second. If you're worth 53 billion, rhetorical question, why are you raising 750 million in a bond issue? You got a problem with liquidity? So you get the picture. Can you speak to how widespread, the illiquidity problem and GPs don't want to give the money back, they can't get it out, blah, blah, blah. Just seems to me this could be a real big problem now. What are your thoughts on this, TX?
Yeah. Again, I'm no longer 100% in the business, so you got to take that with a grain of salt. But I did experience that because when I last place I worked, we had two LP interests in a, but they were quasi VC funds that had done. One of them had a unicorn that had done like 300x whatever. So our LP stake had gone up like six or sevenfold. But we could not get out because there was no liquidity event. The company had not been listed. It was not ready to be listed. So I picked up my phone and I called some guys on the West Coast. I can't even remember the name. I said, "Okay, we have this. 85% of the fund, especially in VC fund, because most of the time there are 15 names in there and 12 of them are going to go bankrupt, and you're going to have one or two or three unicorns if you're really lucky that are going to make 98% of your performance." But anyway, so the guys, they gonna look at what's really inside the portfolio, and it's like what I was talking about bonds. It's really gonna be on a name by name basis, and whatever names they are in the piece of paper in the LP that you own. There is no like a general market of like okay, it's 75 to 80. It's really on a LP name. Essentially, what fund are you in? What's in that fund? Are those companies making money? Are they on the verge of going bankrupt? Who are the private equity guys behind them? Is there some leeway? At the end of the day, we ended up selling the stuff at 90 cents on the dollar. On the
What?
dollar.
Wait, whoa, 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 whoa. You said you were up multiples and you wound up selling it for 90 cents on the dollar?
Yeah, because guys were it was the time when all the VC unicorns were beat up to the sky. So people wanted that stuff.
So hold on, just so we understand this. At one point, you couldn't get out, but at one point, it was a 5X and you wound up selling it at 90 cents on the dollar. Is that what you said?
No, yeah, I'm not saying at one point we could not get out. I mean, at the
No, no,
point
I
when,
understand, but on paper, in theory, it was worth 5 times what you paid for it. You wound up selling for 90 cents on the dollar. Is that what you said?
yeah, which was extremely good because
Oh,
the
that was
market was
good. That was good. Oh
no,
boy.
which was extremely good, but the market conditions were way different. I
No,
mean, yeah,
I
VC.
get it, TX. I'm agreeing with you. I'm just saying I think the shock and horror that people are in for with hearing if your story repeats itself again. Oh my God.
Because these are because the underlying unicorn that people were thinking it's going to be the next Google or whatever. I mean, it was still trading at 7 or 8 times sales, some stupid valuation. So we said, screw it. And God knows what it's worth today. So what I'm saying is that, yeah, okay, got lucky back then. If it's the same thing today, given what's going on in VC land, which I know a little bit from my son, because if he does that, you're not gonna get 90 cents bid. You're gonna get the first bid you're gonna get is on a decent underlying portfolio. I don't know what it's gonna be. 76. I don't know. I mean, if it's only
No,
50 on the
it TX. Let's put it another way. Let's put it another way. Okay. If you're hard, and I'm gonna. It's an unfair question, but just the
but
best.
but by the way, George, why is Harvard and Yale and all those guys, what are they in a sudden rush to sell that stuff?
Well, they got a problem now because they got a problem because and Stav, you should weigh in on this, Stavros. They got a problem because Trump is now making noises about stopping the federal funding and the administration, the bloat that's occurred at these places. Spending's gone out of control. So you saw already, a few weeks ago, Trump said he was going to pull 400 million from Colombia. I'm not sure what's going on there. Harvard, he mentioned, I think there's 2.2 billion a year, 9 billion in total. So these guys got a real cash flow problem now. And also, if you look at the liquidity or the illiquidity of these institutions, over the years they've gone more and more and more into illiquid private crap and away from public markets. Stavros, I know you have a perspective on this. Did you want to add something, Stavros?
No, that's exactly right, George. They were getting great returns in the endowment, model, and they were outperforming the public markets, and they were the darlings, and everybody copied each other, and they ended up with all these, private deals, and all of a sudden after COVID, it was harder and harder to get out, and so that's why. And then now with Trump, basically killing the operating budget, taking research grants out, and leaving the university, is coming to the endowment saying, "Hey, we need budget, operating capital. Plus, I'm sure they have to pay their lawyers since they're suing Trump. So yeah, they're probably been told, to get liquid."
Yep, 100%. All right, let's hold it right there. I want to go to, I'm not going to pronounce his first name correctly, but Mr. Aykroyd, if you could please speak up. I don't want to mispronounce your first name. How do you pronounce your first
Hey,
name, Mr.
George.
Aykroyd?
Junaid.
Junaid, hey, good to see you. That's great. So yeah, go ahead. I know you have a
Yeah. I
question,
have a
so
quick question. So,
go for it. Stavros, I think this is going to be for you. Go ahead.
yeah, so the market obviously has rallied significantly off the lows. And, Trump has been on TV talking about how we had, the best 9-day run, 9 days in a row run in stocks in a long time. And I think the result of that is that the Trump administration broadly has been kind of emboldened. And so, kind of looking forward, like, what do you guys think the odds are that as a result of the market rallying so much, that these tariff policies are harsher than expected,
Or what than expected? Sorry, I didn't
are
hear that.
harsher, just more
Harsher,
aggressive?
tougher. In other words, Stavros, he's got more room to talk tough now because the market's up.
Well, it's he has selective recall. He caused it to go down. So it's it's his mo is to it's all leverage, it's all negotiations, and I think I mentioned last time that those are hard to do when you're dealing in a small village of these countries. They all know each other. That you got to show up again. So he's looking for off ramps, but I think he doesn't care so much about the stock market. I think it's the bond market this time around that he really cares about more than the stock market. But he'll take any branding opportunity that to tout his agenda and how good he's doing.
Yeah. Hey, Rusty, you still there, Rusty? So,
Yeah, I'm
yeah,
here.
this is for Rusty or Stavros. So, depending on which day of the week, whether the market's going up. So, Rusty, I'm gonna tease you. I'm gonna make it for you. Is this, as Trump said a few weeks ago, Biden's stock market, or now that it's going up, is it Trump's stock market? He keeps changing his mind all the time.
I'm going to defer to.
Stavros, Stavros, since you're hiding on an island somewhere, they can't come after you. What's your take on that, Stav?
It's the people's stock market.
Yeah,
It's he doesn't. I mean, he's by his own admission, he's not following it, right?
yeah. I
I'm
don't.
gonna.
So go ahead,
I'll.
Rusty. Go for it. Go for it.
I'll say I'm gonna use Jay Pulaski's touch. Don't pay attention to his commentary.
Exactly. Yeah, and that's a great. I'm glad you brought that up. Jay was saying his superpower is to ignore what Trump is saying. And I think that's right because yeah, and by the way, let's be very clear. This space is not meant to be political. It's no one's saying they're for Trump or against Trump. We're just trying to react to the financial movements, in response to his open mouth operations. That's all. And so, but I know, but I think it's right. I think the question that Junaid asked is correct. I mean, clearly, I mean, don't you find it kind of odd? I mean, by the way, of course, everyone's chirping over the weekend. We had 9 days in a row. It's unprecedented. This has only happened 3 times in the history of the stock market, and blah 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 blah. Just when all the talking heads started doing all that nonsense, well, guess what? It wasn't the market down today, Rusty. I think a little bit or so. I don't even know. But at any rate, um, it's isn't it kind of interesting, Russ? You go back 2 weeks ago before the market started on this run, that basically for like, whereas previously he'd been bashing the market with his running his mouth every other day, he got strangely quiet for a few days. And so some people observe, like, he must have been told to keep his mouth shut. And maybe we discovered where the Trump put or the equity put or the Trump bond put was, because things were getting out of control. I mean, how'd you respond to that, Rusty? That makes sense to you?
Yeah, I would say it was some of that just and letting earnings do its thing. I really don't. It's hard to judge, and like
Yeah.
I that's why I go to Jay Pulaski because that's the way I feel about it, and that's why I kind of asked a question about oil because I'm not trying to like
Yep.
get in the guy's head because yeah he'll say that drill baby drill.
Yep.
I don't care. I'm trying to look at it from the perspective of like what is happening. Jay's that's what I loved about what he said because I've always felt that way. He's all about action,
Yep.
and I've always felt that way about it. Right. So
And that's another problem too. It's become a national sport, a national pastime. You go in these spaces, and for those of you who don't know, his Yiddish is not that good. Yenta means big mouth gossip. Okay, everyone's Yenta, freaking expert about Trump's trade policy. He's going to do this. He's going to do that. Nobody knows what he's going to do, including him. He changes his mind every other day. So if you happen to be lucky and guess right one day, it's going to be something the next day. Highly, and then by the way, this gets back to the old line I've used a number of times in these spaces over the last few weeks. And Stavros, this is an invitation for you to weigh in. Markets can price risk. It's like, they can price what's the odds you're going to be hit by a car, but they cannot deal with flat. They cannot price uncertainty. They cannot price flat probability distributions. And put it another way, this is conducive to lower, not higher valuations. And I think part of the reason that the markets rallied the last couple of weeks, and again, this is hindsight, but people think that they have a better idea that they've seen the worst of the trade threats, and the second derivative on the trade news is negative. So market's gone up. So I don't know. Stop thoughts.
Yeah, I mean that's the market, George. My point earlier was imagine if you're running a business and you can't,
Yeah. Good luck with
you know,
that. Good luck with that.
good luck with that. I mean, where I have to now figure out where I'm going to get my supply that I had planned, 2 years ago. And you have to negotiate it. You have to go there, check the quality, check the pricing, and you can't price it because you don't know what the tariffs are going to be.
Yep. Yep.
So you freeze, you're paralyzed, and you're starting to see it in the statistics, the new order books, and all that. But the problem is this could all be undone, right? It could be they could fix it, and then off they go, and then life will go, and then obviously the stock market will react faster. But yeah, uncertainty is what's caused the drawdown to begin with. So he's holding the cards in terms of the short run.
Right. But as we know, and as Michael Kramer famously coined it a month or two ago, in case anyone uses it, Mr. Market holds all the cards, not Trump. Mr. Market holds all the cards. So
Correct.
Trump can try to
Correct.
engage in open mouth operations, but you can't bullshit the market the market will see right through it as it already has. All right, Stav. It is now 1 a.m. where you are. It is 6 p.m.
What?
See what happens when you're having fun.
Yeah.
So we're gonna call this unless anyone else has got a question. We've been going an hour 45, and I told you it would only be an hour 15. I lied to you. So tomorrow we're having Spencer Hakimian from Tulu Capital Management. He's got a great feed. You should definitely follow him. He's going to be on at 4:15. And I want to remind everyone again, shamelessly plugging the conference we're having. It's going to be Thursday, June 5, a paid online virtual conference with it's a who's who of the smartest guys in the room, from Michael Howell to Jay Pulaski to Jordy Visser to Mike Rothman to Tavi Costa to Stavros to Mark Cahodes. I mean, just go down the list. It is truly murderers row.
I was about to say you need to call it the Murderers Row.
Yeah, maybe we should. I don't like George. I mean, stop. We got to work on that name, George Noble's Investment Conference. It's kind of lame. Maybe we should call.
They might not let me back in the country if I name it
Yeah,
Murder
I know.
Row.
I know. They hear murder.
I might end
Yeah,
up in El Salvador.
exactly. All right, listen. This has been fantastic. Thank you, Stavros, Rusty. I know where TX went, Junaid,
Thanks,
etc.
George.
Everyone else has been
Talk to you.
fabulous. See you guys again tomorrow at 4:15. Take care. Bye bye. Good night.